All right, welcome back to the Wise Old Owl Show. Today we're going to do things a little bit differently. I'm happy to have one half of the team of the Canadian Real Estate Investor Podcast with us, Nick Hill, and also one of our new colleagues at OwlMortgage.ca. We're going to talk about everything that's going on in the market today and get a feel for what's going on the investment side of the equation. But first, for those of you who haven't already, please subscribe, share, and like. And if you want to win one of our prizes, we're trying to get to 10,000 subscribers. We're getting close. So hit or put in mortgage in the comments and you'll be eligible to win one of our prizes that will be given out when we hit 10,000 subscribers. So Nick, thanks for joining us. What an interesting time. You have been rocking it with your partner, Daniel Foch, on the podcast, the Canadian Real Estate Investor Podcast. And you've also been traveling the country doing meetups with this cult-like following of your podcast. And you've really been able to get a feel for what is going on across the country and the appetite for folks that are looking at investment properties. So can you share a little bit about what you've been up to, how it's going, and what the sentiment is in the marketplace as rates have come down?
Yeah. First and foremost, absolute pleasure to be back on the podcast, Vince, and I guess one of your first Riverside online recordings here. It's
I was
exciting.
finally able to figure it out. I've always been nervous about this, but we're gonna give it a go, and hopefully it works out.
Here we are, baby, and you know what? No technical difficulties, which is fantastic. And for everyone listening, go and do what Vince said. Go put that in there. Vince puts out an incredible amount of really informative content. And since we kind of joined forces, Vince, I just think things have been going a lot better for both of us. And I'm very excited for what the future has to hold. And I'll use that as a segue into kind of the sentiment that I'm seeing across the country. So, I think sentiment changes on a market to market basis. And I'll explain that as after I do a quick explanation as to why we've been traveling across the country. So yeah, you're right. Last week I was in Winnipeg. The month before that in Ottawa. Month before that Saskatoon, and we've been to Calgary and Edmonton and Vancouver. We're just about to hit all the East Coast cities. We've been all over Ontario, and sentiment is very different in all those places. And the reason we've been traveling to those is because we have a very large podcast following, which is incredible. But the podcast, as you know, is, Dan and I on Riverside usually, or in our studio. And we've got all these amazing listeners in different places across the country. So we figured, okay, let's use this opportunity to go around and actually, instead of just doing the URL stuff, the online stuff, let's do the IRL, the in real life stuff, and really go and get boots in the ground, do property tours, and actually meet the people that listen to the podcast and hear what they have to say, what's going on in these different markets, because Edmonton is very different than Saskatoon. Saskatoon's very different than Kingston. Kingston's different than Ottawa, different than St. John's, different than Vancouver. So, I'll start with Winnipeg because that's the freshest in my mind, because I was just there last week. The sentiment in Winnipeg, we had a lot of very young people come out. I'm in my mid-30s. The average age there was probably people in their mid-20s,
Wow, that's impressive.
Yeah, it was.
I'm a little bit taken aback by that.
The only downside was it made me feel very old because I had a bunch of people being like, mentor me and all this stuff, and I'm like, I'm not that old, guys. But it was fascinating. The first thing I'll say is, no one in Winnipeg is thinking about Toronto or Vancouver. They, for them, their mecca when they talk about the big city or maybe leaving Winnipeg, all these younger people that we were speaking to, they wanted to go to Calgary. That was their big city. That was their kind of maybe next step. Where do you want to move in Canada? It was to Calgary. But it was fascinating to see what was happening in Winnipeg. All these people in their early 20s making some serious moves. Buying multiple properties, teaming up with people, and buying properties, or even buying small portfolios. And as I mentioned, one of the things that we love to do when we travel across the country and we get our hosts of these events to go and tour us around some interesting investment properties. So when we were out there, I was like, I want to see the cheapest properties possible. So we went and looked at just for shits kind of thing. So we went and looked at a single family home listed for $105,000, and that was the list price. You probably could have gotten it for less
This is in Winnipeg.
in downtown Winnipeg. Yeah, the neighborhood wasn't as pleasant as some might like. The other property we looked at, and these were both, I would say in quotations for those listening and not watching, move in ready to a certain extent. The other property that we went and looked at was listed for, I believe, 140 or 150,000, and you could probably gotten it for less as well. So
and these are single family.
These are single families, but one of the rules that has kind of died in real estate investing is the 1% rule, which essentially is if I buy something for $125,000, I need to be making $1,250 in rent. Now, Vince, you and I both know, doing a lot of our operations and some of the multiplexing projects that we do in Toronto, that is just completely out the window. And I can almost say that that's almost impossible in the provinces of both Ontario, British Columbia, and even a lot of Alberta. It's difficult to pull that off. But then you look at the prairies, you look at Saskatchewan and Manitoba, and that is quite possible. Now, again, you have to look at things like tenant profile and cash flow versus appreciation when you're talking about those kind of assets. But just fascinating to see that kind of stuff still exists. So, the sentiment in Winnipeg was, hey, things are good. We're rocking and rolling. It wasn't the doom and gloom that we talk about a lot here in Toronto, and it was similar in Saskatoon when we were there a few months ago.
What type of rents would these properties garner? Like if you had to estimate, what that $105,000 property would go for in rent, or that 140 K property, what can people anticipate?
Yeah, I mean, it all depends. It's all subjective to what kind of tenants you're putting in there. Are you sprucing it up a little bit? Are you doing anything? The one that was listed for, I can't remember if it was 140 or 150, but you'd be easily over that $1,500. You'd be easily
over the 1% number.
You'd be over the 1% rule. The one that was listed for just over $100,000. Again, not a nice neighborhood. There actually was some new developments in the neighborhood. I think the gentrification process there is going to be a little slower, but you'd still be able to easily be cash flowing. Now, mind you, again, we all know that tenants are the real asset when it comes to real estate investing. So you're going to have issues there, not guaranteed, but likely, I would say. But again, if you're a young person looking to start out, if you're someone in the prairie provinces or even somewhere in the GTHA or the lower mainland in Vancouver, and real estate just seems like a complete impossibility for you at this point, there's a lot of Canada out there that is not in the same ridiculous unaffordability that some of the provinces and major cities have come to.
So Nick, let's hone in on the demographics here, because you said you're dealing with a very young cohort in their 20s. Are these folks buying their first property and having it be an investment property, or are they already in the real estate market as a homeowner?
Yeah, it's a great question. I'd say it was probably half and half.
Okay.
For me, Vince, you know this. I rent. I've been renting for quite some time, and the ability to save for down payments for rental properties while I'm renting myself has helped me immensely. Right? If I had to go and spend that $75,000, $150,000, $200,000 to buy something here in Toronto, the portfolio that I've built up with other people involved likely wouldn't have happened, or would have happened a hell of a lot slower. Now we're talking about affordability out there. That that $100,000 property, let's say, you could literally go buy that thing for $20,000, and even if you left it vacant, which I never advise, but even if you left it vacant, you're essentially losing as much money as some condo investors are losing money here, right? Like
That's a
it's
good point.
crazy. Yeah. So I mean, yeah, I'd say it was half and half. I'd say some of the guys there that we had spoken to were, had got a couple buddies together and were doing the classic, get two or three friends together, uh, pool your money and buy some properties. I'd say more of them had focused on investing before. Like some of these guys still lived at home, you know what I mean, and owned three properties, kind of thing. And for me, as obviously a lover of real estate and a believer in real estate investing and not just from a capitalistic and monetization, financialization of housing, but in the sense that this is a great way for people to get ahead. And not only that, but eventually these properties will be improved by investors and maybe even redeveloped or new units created. So I was really happy and almost proud to see some of the actions being taken by some of the younger people in that market.
You know, Nick, being in the GTA, what you're telling me is quite foreign, right? We always hear the narrative that young people feel that they can't afford real estate, they can't afford a home. And on your show, you've always talked about the opportunities that exist outside of the big markets, primarily GTA, Vancouver area. And I am surprised to hear how young they are. And I find that quite refreshing. It brings back a bit of hope knowing that young people are out there getting into real estate at different levels and quite frankly have their goals set on not Vancouver, not Toronto, but a Calgary. So that's really interesting. I guess that's got to be, was that a surprise to you as you've gone out to these meetups throughout the country and looked at the demographic? Because you're primarily in Ontario doing the initial meetups here, mostly mature people, folks looking for avenues and opportunities to grow value in a very tough market. And now you're going to these other parts of the country and seeing a totally different mindset, a shift in attitude, and more importantly, more opportunity than ever in the investment space. How did you react to all this?
You know, Surprised, yes, and very pleasantly surprised. I think I'm a little bit spoiled in the sense I was born and raised in Vancouver and have spent most of my adult life here in Toronto, frequently going back to Vancouver. And it wasn't until the last few years where I really started to look at the rest of the country as really the land of opportunity. Vince, you mentioned the hardships of people trying to invest here in Toronto. I think that Toronto is an amazing market. I think it's a lot. I think the barrier to entry is 10x, if not more, as it would be in these other markets. And some of the people were as young as 18. I'd say the average age was early mid 20s. And I think it was fascinating that none of them had traveled to Toronto or Vancouver, and the desire to go to those places wasn't even there. They were like, yeah, I go to vacation in the States, and my Mecca's Calgary kind of thing. And it was the same thing in when we were in Saskatoon and Regina. And I just think the opportunities in those kind of often overlooked and forgotten about markets is massive. Again, from a barrier to entry standpoint, people get so fixated on, I want my investment property to be nice and sexy, and the wants and desires usually don't add up to the reality. And I was telling some of these younger people, I was like, look, you want to invest in turnkey sexy stuff, whether it be here or south of the border. Well, have fun saving up for the next 5+ years and watching opportunity pass you by. For me, and I hate to use this, but it's not timing the market; it's time in the market. I hate to use that cliche, but it's so true. So for me, I was telling these guys, I'm like, look, like, can you guys get $20,000 together to buy this property and be happy to like sit on it for the next 5 or 10 years as you grow a bigger portfolio? By that time you'll be still less than my age, and then go and sell that portfolio that you've built up, and then go and flip it into something bigger and better and easier to manage. So yeah, very very pleasantly surprised. And as you said, it kind of really reignited a hope in the youth in Canada and the opportunity in real estate, because I think the opportunity in Toronto really comes from doing some of the stuff that you and I are doing, and some of our partners in the space are doing, which is the multiplexing, right? The adding
Yeah.
density, the adding units, taking advantage of certain programs like CMHC's MLI Select and certain other financing, the fourplex and avoiding development charges. But that's expensive to do, right? No, there's no two ways about it, right? And I think that investment vehicle is great for some people, especially when they're looking at more of an appreciation play. But for younger people that want to get involved in real estate and look at, are in the GTHA or in the Lower Mainland and are trying to figure out what the hell to do, I would say, look elsewhere.
You know what? This is great news. I feel like you've opened up a window for people to think outside the box, and that box always seems to be GTA, which leads me to my next topic, and that's all the government programs that have been introduced of late. Going back a year ago, we got the Housing Accelerator Fund introduced by the new housing minister at the time, Sean Fraser. Um, all these new changes. I think November 21st, we got the stress test being eliminated on mortgage renewals. And this is all in the name of affordability, right? And a year later, it doesn't seem like there's many new housing starts. There doesn't seem to be more affordable homes. It seems like all these programs are geared for renters, right? Taking off the GST on purpose built rentals. The new program announced today is more related to rental programs by the finance minister. Is this all window dressing? Is this all bullshit and media clips? Because the reality is the biggest issue is development charges. It's the biggest chunk of the cost of a new home, and it has actually gone through the roof over the last 10 years. And I was with a builder not too long ago, a few nights ago, went out to dinner, and he's got access and on the table thousands of new units that could go to market. But his biggest thing is the process. In the city of Toronto, he needs to get almost 35 studies and reports done that have to be submitted with a permit. And I'm putting out a post in the next day or so about all these reports. I list them all, and it is unfucking believable. And that doesn't include the 25 plans he's got to submit with his permit. So it's up to 60 plans and studies and drawings. Like, that costs money, costs millions and millions of dollars. Everybody wants to pick on the developer, but at the end of the day, these politicians are being pigs at the trough, collecting hundreds of thousands in development charges per unit, which in fact the homeowner is going to pay for. So how does this end? How does this improve? Help me make sense of this from your world where you're talking about this all the time.
Vince, if I could make sense of it, I'd probably have a much higher paying job and probably wouldn't be here with you. Unfortunately, I don't have the answer. What I will say, and I'll start this off with a Twitter post that my co-host on the Canadian Real Estate Investor Podcast, Daniel Foch, just put out, which was kind of mind boggling. And that's GTA development charges cost more than a condo in Edmonton. Okay, let that sink in. So, Vince, you and I are in this space, right? We have to deal with the development charges on the 4+1 units that we build,
Yeah.
and they're astronomical, right? I mean, like literally, like we're talking, down payments for condos outside of Edmonton, in many other places in the country, down payments for houses, right? We're talking $50,000-$60,000 plus, and that's just the development charges, let alone all the studies and the permits and all the other stuff that you mentioned, all the other hardships that we all go through. Is it window dressing? I think you called it. I'd say to a certain extent, yeah. I think that it's nice to finally see policy slowly start to go in the right direction. But an announcement of one policy shift or one new piece of legislation or one new rule, it's going to take more than that. It's taken us a long time to get into this predicament that we're in right now, and it's going to likely take us a long time to get out of it. And when developers and real estate investors are constantly demonized by trying to add units, which we desperately need, it really just becomes it's just totally the wrong way to look at things, right? We've got a cohort, yes, and developers. I'm sure that the owners of the development companies are wealthy, and should they be? Yeah, just like the owners of the big tech companies on the devices that you and I are doing this and the programs that we use every day, should they be wealthy? Yeah, for sure. But don't forget that outside of the wealthy developers, the people at the top, there's hundreds, if not thousands, if not hundreds of thousands of people that are employed within the construction, the lending, the permitting, the surveying, the appraising. Like this, construction and real estate make up, I believe, over 25%. I think it might even be 30% of Canada's GDP. So when we start to demonize the major players in that space by trying to do their jobs, it's backwards, right? I mean, and I don't want to get political here because I think that I know you and I can agree, and I would assume most of your listeners would as well, that our current government has really done some serious damage. But I'm not extremely bullish on any government being able to fix this problem that we found ourselves in, at the drop of a hat or the snap of a finger. It is going to take time, and it's going to take some serious action, right? Like, let's immediately remove development charges from the 4+1s. Why is that a thing? Or even remove development charges in general, right? I mean, we pay so much tax. Every piece of a house is taxed, from the labor to the lumber to the concrete to the rebar to the kitchen cabinets. We pay tax on all of that stuff. So why are we paying this lump sum tax that really kills a lot of incentive to develop? And then eventually that cost all goes back to that consumer, and those consumers are turning more into renters. And Dan and I talk about this a lot on the podcast, is we are heading towards a renter's economy. And you see this a lot in other parts of the world where home ownership levels, even in Switzerland, for instance, are lower than they are in Canada.
Well, Nick, when you bring up that point in comparison to Europe, Europe has a 50-50 split between home ownership and renters. I think in Canada we're about 62%. That number slowly going to get
we're
close.
A little bit higher. I think we're still in the mid 60s, if I'm correct.
I was under the impression it was there, and it's starting to trickle down. And I think we're going to move towards 50%, because the reality is when immigration lands at our borders, they all come to the major centers, which puts too much pressure on the housing stock. And quite frankly, they can't build single families at the pace they need to. It's just not happening. I think there was a report that came out that Ontario is at a 69-year low in new single family home sites. So it's just not happening. This accelerator fund, suck it and park it. If not, it's in reverse. It's not going anywhere. But I want to point out the issue of time. When you need to build things fast, you have to eliminate red tape. And I have this on record by a good friend who stopped building here in Canada and moved down to the States. And he's building in Texas, a suburb of Dallas. I think it's Anna, Texas. And he basically told me, he goes, Vince, the municipal leaders are taking us out to dinner to ask us to build. Now, they charge a little bit more in property taxes down there because that's what their draw is, right? But they are amortizing infrastructure costs over time. Whereas in Ontario, they want to pay for everything up front. And it's unfortunate that the new homeowner not only has to pay for today's infrastructure, but when infrastructure is built, it has to be built for future growth. So they're overpaying. And Quebec amortizes infrastructure costs, Ontario doesn't. We need a new model because it's just not equitable anymore. And if you're expecting people to build the infrastructure for full communities, things just aren't going to get built. People aren't going to take it anymore. They just can't afford it. And when you're talking 200,000 plus, that mortgage payment on $200,000 is a lot of money. Amortize it, increase the property taxes, stop trying to cater to your constituents to stay in power, and do the right thing and pass on the property tax nut to the residents of the community, because it just doesn't make sense. You're never going to build for the growth that they had planned. Now, we do have the immigration minister cutting like crazy, realizing they really fucked up. But I think the damage is done. I think it's
Yeah,
too
too
late.
little, too late. Yeah, too little, too late. I completely agree.
And I guess my question is, how are the immigration cuts going to impact the rental market?
Yeah, yeah, that's a loaded question because I think just like with everything in real estate, and in the general economy, just like, Vince, an interest rate takes 18 months to work its way into the economy and, a similar time to work its way out of the economy. I think when we talk about the immigration stuff, first of all, it was completely and utterly unsustainable to begin with, right? We see, some of the colleges, whether it be the quote unquote strip mall colleges that didn't even really exist, or the real colleges that kind of looked at this as a gold rush. They were accepting in the thousands of percent new students every year, right? So I mean, this it was just a completely broken system to begin with. I think that we are still going to be facing the same issue and the same problem, regardless if immigration got turned off immediately and fully, or if it's dumbed down by 50% or 30 or 20 or 75 or whatever it ends up being, because I know it's a bit of a moving target and politicians say one thing today and another thing tomorrow and another thing next month. I think that the lagging effects of that are going to be probably long. We have seen rents come down a little bit for the first time in quite a while here in the GTA. But we've also seen housing starts, drastically go down. So, I don't really have a great answer for that. I feel it's going to be kind of a bit of a moving target. There's so many people here, whether it be immigrants, brand new immigrants, or people that have been here for a few years, or people that have lived here their entire life. The problem remains the same, and that number of 3.5+ million new homes from CMHC, Canadian Mortgage and Housing Corporation, that puts out a lot of this data. That number hasn't shrunk. Like we're still years and years away from even achieving that, and actually, we're going the wrong way, as you pointed out in some of these major markets. So I wouldn't, like, for me, I wouldn't worry about that. I've had that question come up a few times. Are rental rates going to go down? Are we going to see decreased growth? Well, likely no, but we're hopefully going to see more sustainable, achievable growth, and growth that we can actually be a little bit more proactive about, and a bit more, because we're going to be in reaction mode for years now with this stuff. But can we react better and quicker, instead of looking at this as, pushing a boulder up a mountain? Can we figure out a better way to do this? So don't have a great answer for that, but I would say that's not a major concern of mine, at least for the time being.
We're going to definitely have to see how that plays out for sure.
Yeah.
I can't believe we're almost on to half an hour here, but I
Feels
still
like
had a lot more to ask you, but we're going to wrap
let's
it up, and
go.
we're going to
Yeah.
get you back on
My
for another
pleasure.
episode to
Love
go through
to.
the rest of these questions. But before we go, this week, StatsCan announced that inflation kind of rallied a little bit, went back up to 2%. We got job numbers coming out at the end of the month. We got one more Bank of Canada meeting before we wrap up 2024. Where do you see interest rates going? Where do you see inflation going? And do you see a problem brewing early in 2025 at all?
Oh man, this is the last question you want to ask me for a wrap up. This is a big, come on, man. Let me go to the room and get my crystal ball here. Vince, you and I both been in the mortgage space and working together. I think we agreed a long time ago that we're not in the business of predicting, but it is always fun to talk about this stuff. So none of this is a prediction. This is just kind of the way I spend a lot of time looking at data and reading articles and predictions and things from economists much smarter than I am. And it has been so freaking back and forth. I don't even know which way to do it. Before I get into what I'm going to say next, I like to say that for anyone listening that is thinking about investing, um, don't let an interest rate hike, cut, or hold dictate what you're going to do. If something goes up or down 50 bips and your investment stops working, it's not a good investment. So zone in and tune out the noise of all the ridiculous stuff that's happening out there and figure out your investment thesis and figure out a way to make money in real estate because there's so many good ways that aren't going to be affected by a rate cut, hike, or hold. But to go to your question, what do I think is going to happen? The inflation numbers, I kind of
Could be short lived. Could be
yeah,
short. Could be
exactly.
a little blip.
I kind of saw that coming with like the big drop that we had last print. It seemed a little too good to be true. I agree. It could be a quick blip, and that's why the that's why it's so dangerous to predict this stuff or to like to really ride on that kind of stuff. We had that 50 bit cut last announcement, and everyone was calling it a jumbo cut, and they can't believe it. I mean, if 50 bips is a jumbo cut, then so be it. Um, I think that the inflation numbers might scare the Bank of Canada a little bit away from that other potential 50 bip cut that a lot of people were predicting. When we do multiple 50 bip cuts after multiple 25 bip cuts, and when I say bips, sorry, that's a basis point, so
Yeah.
0.25%. That's what that looks like. That is a signal to the rest of the world that our economy is not in good shape. Right. And yes, inflation went back up, but we're still within that 2 to 3% range, right? We're still right where we want to be. So now it's just going to be about the Bank of Canada trying to level things off. And really all this comes down to is trying to control consumer sentiment more than anything. So what do I think is going to happen next? Now, I'll make a prediction here. I don't think we're going to see a 50. I think we're going to see a 25 based off of the inflation and the job and the movement in the real estate market. There's a new political figure coming into power in a few months south of the border, right, which I think is going to shake things up in the Canadian economy to a certain extent as well, both good, bad, and ugly. So yeah, I would say I'd be comfortable with a 25. I think that would be prudent of them. I think 50 would be too much, and I also don't think a hold would be a horrible idea. Maybe hold and continue the cutting cycle in the first couple quarters of 2025.
Well, you touched upon it briefly, but I do believe if there's one thing I have seen the latter part of this year is that sentiment has changed. There's a little bit more confidence in where rates are going. That's making people smile a little bit more. And that's all good news. But when rates get cut, that means things are not good. And we're going to have to brace ourselves. We're going to have to tighten the chin straps on the helmet, get through the first part of 2025, because I think after that, I think we're going to be in pretty good shape with all the renewals coming in, people not worrying too much about where rates are landing. It's not going to be too big of a nut that they're going to have to face compared to where rates were earlier in the year. So I'm a little bit more optimistic, but I still think we got a lot of runway to deal with some trouble. But let's leave it there. I want to thank you for coming on. We got to get you on again. I think this was great. Say hello to your partner in crime, Dan, for me, and we're going to do it again. So,
My
folks,
pleasure. Anytime.
if you have any questions, you have any comments, please put them in the comments section. I look at all of them. We'll try to answer them, and I'd love to get your feedback. So, Nick, thanks again. Really appreciate it. We'll see you soon.
Vince, my pleasure. Thanks.